Good afternoon. Good afternoon, everyone. My name is Jeremy Sauter. I'm the Director of Membership for the French-American Chamber of Commerce. It's a pleasure to welcome you today for the second webinar of our federal stimulus series on COVID-19. We're delighted to have such a large and diverse audience today that represents well the diversity of our membership. We have members in banking, accounting, venture capital, food and beverage, media, beauty, fashion, human resources, and software as a service. So really reflecting the diversity of our network. So today we're going to talk about the Paycheck Protection Program, of which you have heard of. It's a great program rolled out by the federal government to support businesses such like you in this very difficult time. And the program basically is aimed at subsidizing the payroll, rent, and utilities expenses for up to 8 weeks. So of great need to many of us. So we're going to hear from experts from Mazars USA, one of our leading accounting firms in our network, who are going to help you decipher this program and talk about eligibility and also calculation of the loan you could be expecting to apply for. So I would like to present to you, introduce our two speakers. We have Ryan Vaughan, who is a director of the tax department at Mazars, and he's also leading the Chicago tax practice. And we have Alisha Jernack, who is a senior manager and entrepreneurial business services and advisory group at Mazars USA. Before we start, I would like to just take care of some housekeeping issues. So you see on your control panel on the right of the screen that there is a questions section. So throughout the webinar, throughout the presentation, you're going to be able to type in the questions that you have. And then at 2:40 p.m., we will start the questions and answer session up until 3 p.m. And then this webinar is recorded, so you will receive a link to download the recording of the webinar, and also we will send the slides of this presentation. So without further ado, I would like to leave the floor to Ryan Vaughan of Mazars USA.
Jeremy, thank you for that great introduction, and we're happy to be with everyone today. And I guess before we get in too far, would want to just take a minute to reflect on, what the reason that we're gathered today is, the current pandemic situation, and we want to be sensitive and our deepest, sincerest concerns to everyone who's been affected, and hopes that everyone recovers and we can proceed back to normal and be a stronger world as a result. So thank you, everyone. And our goal today, as Jeremy mentioned, is to discuss mainly the Paycheck Protection Program, but also some of the other tax provisions of the CARES Act, which was passed last Friday, or 2 Fridays ago, March 27th. And we've been seeing changes and updates to this legislation through various outlets of guidance for those past 10 days, and it's been quite a ride. So our goal is to give you the most up-to-date information that we have on the Paycheck Protection Program, along with other areas of the CARES Act. A brief overview of our agenda is to cover the Paycheck Protection Program, or the PPP, talk through some of the important timelines and dates, take a look at the analysis tool that we developed here at Mazars USA to help companies maximize their loan amount and manage and maximize their loan forgiveness amount. Talk through some of the nuances, benefits, and pitfalls of the program. and then move into some of the other areas of the CARES Act related to employee payroll taxes and business income taxes. And then we'll, as Jeremy mentioned, open up for a Q&A session at the end. So again, we are presenting our most up-to-date knowledge of this, and further guidance is expected to continue really throughout this process. So as that happens, make sure you check back with us for future updates. And here's just a quick overview of the purpose. Again, is to talk about the CARES Act and the PPP program. And with that, I will turn it over to Alisha, who's going to walk us through the PPP program.
Thank you, Ryan, and hi, everyone. So as Ryan mentioned, we're going to take you through now an overview of the Paycheck Protection Program, which I am sure many of you have been hearing about over the past several days, and I'm sure your heads are spinning. A lot of additional guidance is coming out every single day. If you haven't applied already, I'm sure you are going to, if you meet the terms of a small business, you're likely going to be applying today or tomorrow, and you should be doing so with your banks. So we'll jump right into it. So what is an eligible business? An eligible business is a small business or nonprofit as defined by the size standards provided by the SBA, or a company that has less than 500 employees. You are also eligible if you are a sole proprietor, if you are self-employed, or you are an independent contractor, and you must have been in business on or before February 15th, 2020. The maximum loan amount you can receive up to $10 million, but the amount of the proceeds is calculated by taking 2.5 times your average monthly payroll cost during a 1-year or 12-month period before the date of which the loan is made. Again, not to exceed $10 million. If you are a new business, you may still be eligible, and the measurement period for you would be January 1st through February 29th, 2020. And there are terms of forgiveness within this loan, which makes this loan different from other SBA loans. And the terms of the forgiveness are loan recipients may be eligible to receive forgiveness for an 8-week period, which begins at the time the loan proceeds are received. And the forgiveness is equal to 8 weeks of payroll costs, payments on interest of mortgage, rent obligations, and utility payments. There's one important thing to note here in both calculating the maximum loan amount as well as the forgiveness, and that is that there is a cap on salaries. Anyone who receives salary or wages in excess of $100,000, the amount in excess of $100,000 does get excluded. It is also important to understand what is included in payroll costs. Payroll costs include salaries and wages, as well as health benefits and retirement benefits and state and local taxes. And those payroll costs, to calculate the loan proceed amount, it's at the gross amount. You can go to the next slide. Okay, so there's a few important timelines and dates that we wanted to make sure that all of you understand today. I'm sure you're hearing about this covered period. The covered period is, in other words, the loan period. They've made this retroactive, so you can go back to February 15th of 2020, and this goes through June 30th of 2020. The payroll cost calculation, as we mentioned, that is to calculate the amount of the loan proceeds, and it's a 12-month period. Now, that can be either a trailing 12-month period or the last calendar year, so calendar year for 2019. As I mentioned earlier, the forgiveness period, which is a critical time, that 8-week forgiveness period begins as soon as you receive those proceeds. Now, that is a very important date because that is where you're going to have to start managing and measuring certain things to make sure that you're able to maximize that forgiveness component. And with the model that we've developed here at Mazars, we're really aiming to do two things here. One, to maximize the loan proceeds amount and making sure that we're understanding what is included in those payroll costs and how to calculate that monthly average, which we then take the 2.5 times. And two, understanding what we can include in that forgiveness bucket and when we need to start measuring for that forgiveness and how do we measure that forgiveness. The next important date and timeline is there is a deferral period under this. It is to not be less than 6 months and not more than 12 months. So in this example, we assumed that we were going to receive our loan proceeds on April 30th, the end of this month, and therefore we showed the 12-month period of April 30th, 2020 to April 30th, 2021 as our deferral period. Now, very critical here, as I mentioned, in this forgiveness calculation, we're really looking to maximize this forgiveness component. Now, the way that this was written, they give us two options here. We can use option A, where we look at headcount by month. Again, we're calculating an average by month, and this is based on headcount. So in option A, we can look to February 2019 through June of 2019, and we're going to get the headcount per month for those 5 months, and we're going to calculate the average during that period. That is option A. Option B, we're going to look to January and February of 2020, again, getting the monthly headcount for those 2 months and calculating the average. Now here, what we're doing at Mazars and advising our clients, we need to select now, are we going to go with option A or option B? We're advising our clients, we want to go with that lower option, which gives us the lower number. And why? Because that is going to become a base or a benchmark for us. And now, once that forgiveness period kicks in, we are going to have to measure ourselves against that, with the whole point here being that we do not want to reduce our headcount below what the average was before in either option A or option B, whichever option that we selected. So for instance, say in option A, we had 105 heads. That was our average. And in option B, we had 100 heads. And now we receive our loan on April 30th, and our forgiveness period now kicks in and begins for May and June. That's our 8-week period. And now our headcount goes to 95. Well, I would have selected option B, 100 heads. And now I have 95 employees during my measurement period. And therefore, I am only going to be forgiven 95% because my headcount was reduced from 100 heads to 95 heads. So this is where this is critical, and we really encourage you to work with your advisors to understand what is the best option for you and how do you make sure that you maintain that consistent headcount to maximize that forgiveness. And in addition to headcount, they're not only looking at headcount, they also want to make sure that we do not reduce our total salaries and wages in excess of 25%. So you will see as we continue to go through the model that we're looking at both headcount and dollars, because we need to make sure that we do not reduce our total salaries and wages in excess of that 25%, or then that also reduces our total overall forgiveness. I also want to mention it's important to understand the definitions of what else gets included in the forgiveness. So we know we have 8 weeks of payroll costs. We also have the covered mortgage obligations, which we mentioned earlier. And we have defined that as any real or personal property that was incurred before that date of February 15th, 2020. So again, another important date. Rent obligated under a leasing agreement, also enforced before that February 15th date. Now that could be your office rent, that could be off-site storage, that could be capital lease obligations. And then lastly, we have covered utility payments. Normal utilities, electric, gas, transportation, phone, or internet, again, before 2/15. We're seeing we have many companies that have remote workforces now, and they may have additional expenses, but the caveat here is understanding how the law was written and that this service must have been there before that February 15th date. So these are the important timelines and dates that we have laid out for you, and the importance of understanding this forgiveness period, when it begins, when it kicks in, and when you need to really start measuring and managing your headcount and your dollars. So here, I don't know how many of you have seen the actual application for this Paycheck Protection Program, but you are not able to move forward unless you're able and willing to make a good faith certification that this loan is necessary because of economic uncertainty caused by COVID-19, and that this loan will be used to maintain payroll and make the required payments. The other question that it asks you, as we mentioned earlier, you have to be deemed a small business under the small business standards. There is a size tool that's available online. If you're unsure, you can quickly go on. We can share the link and you can see right away based on your industry. You would put in your industry code and your annual revenues, and you would quickly be able to see whether or not you meet the standards under the SBA size standards. And the main question being, do you have more than 500 employees? So we've answered no, so that we can continue down and proceed with our calculation. Please enter expected date of the loan. So for example purposes here, we're going to put, again, we're in April, everybody is applying today, so we're going to say that we expect to receive the loan proceeds on April 30th. So now we can understand when that forgiveness period will begin and how do we start to measure against that. What is included in total payroll costs? We touched on this earlier, but this is very important to understand so that you can maximize that loan proceed amount. So again, this is for a 12-month period. It can be a trailing 12-month period or the calendar year. You will see different banks are including different time periods on their applications. So it's really meant to be a 12-month period and taking the average over this 12-month period. And that total payroll cost includes not only salaries, it includes wages, it includes tips if you're in the restaurant business, it includes vacation, it includes commissions, it includes leave, severance, and it's important to note that it also includes health insurance premiums, retirement benefits, and state and local taxes that are assessed. Again, we had discussed that there is a cap here. There's a limitation that you are not disqualified if you have employees who earn more than $100,000, but you are limited to $100,000 per employee. So you have to note by employee what are their salary amounts and who receives more than $100,000, because any amount in excess of that $100,000 does get excluded from your calculation. The next question that they ask, what is in regards to something that was passed a few weeks prior, which is the Families First Coronavirus Response Act, which allows employees to go out under FMLA if they either have a child at home that they need to care for, or they are sick themselves or quarantined by a doctor. They're able to go out and have their job protected for a 12-week period, and the employer is reimbursed up to $10,000 dollar for dollar from the IRS in the form of a payroll tax credit. So we are not allowed to double up. So they asked the question here, were any employees that we're including receiving qualified wages under the Families First Coronavirus Response Act? And if they are, we have to note the amount there so that we can exclude it from our calculation. So here we put in an estimated payroll cost amount to show you an example. We put in 3.6 million, and we had calculated what is the average monthly payroll amount. and we excluded anybody who received more than $100,000. So we came up here with our monthly average of $299,000. And if we take that times 2.5 times, that is our maximum loan amount. So here we're showing that our maximum loan amount is $748,000. The next part of our tool that we wanted to show you and give you an example is this forgiveness component. So here at the top, we have included the loan amount, which we just calculated based on our average monthly payroll and excluding any amounts that were over $100,000. Now, earlier I mentioned that there's a few important things. We need to understand what our headcount is before, and we had 2 options there. And then we need to know when are we going to receive the proceeds, and then therefore, when does that forgiveness period kick in? Very, very important to understand and to note, and I would recommend having the conversations and staying ahead of this, get an understanding from your bank should you qualify for this loan so that you can prepare for this. So here we've listed all of our employees and we've noted their salaries, and you'll notice here we've calculated the dollar change in salaries, and anyone who received a reduction in excess of that 25% is going to reduce our forgiveness amount. Also here, you'll see that option A resulted in a lower headcount number. So we are going to use that as our base mark, as our base. And we're going to measure our headcount today during our forgiveness period against that. So you'll see that we calculated this out, and we're showing that our headcount today versus that base period is 96%. So what does that mean? That means that they are going to reduce the forgiveness amount by 4%. They're going to reduce our forgiveness amount also by $23,000 because of the fact that that is the total dollar change in salaries in excess of 25%. Now, I know you can't see that on the screen because we didn't want to show you 500 employees, but you will see over on the right-hand side, there is one employee whose salary was reduced by 80%. So that is going to be part of that $23,000 reduction. Here, we also filled in what is our interest on mortgage. Again, that could be interest on any real or personal property. So we put in $5,000. We said that that was the interest expense for the 8-week period. And we also filled in what is our rent expense for our 8-week period. Again, not just your office rent. This could be off-site storage rent as well. We put in $40,000. What is our utility expense for a 8-week period? And we filled that in, and we put an estimated $5,000.
Excuse me, Alisha. Excuse me, Alisha. Someone is not muted, so I'm gonna ask you to please mute yourself. Thank you.
Could you answer the question?
I'm going to ask, please mute your microphone. Thank you. Thank you. Okay, go ahead, Alisha. Thank you.
Okay, no problem. So here you'll see we've calculated, again, we put in some numbers for an example. We've calculated that the total expenses during that 8-week forgiveness period is $530,000. Now, we had our wage reduction for our dollars, so that is reducing this amount by $20,000, and our headcount reduction because we're at 96%, and that's another $23,000. So our total debt forgiveness is $486,000. So we're showing you here our gross loan amount, and then our debt forgiveness, and then what our net amount is, and then the next step is to calculate what is our principal loan amount now after our forgiveness, and what is our monthly debt service charge that we have to pay to cover this loan, which will be amortized over a 2-year period at 1%. So I know that's a lot. We wanted to kind of wrap this all up and now cover some of the nuances, benefits, tips, and pitfalls. So again, to recap, eligible employers are small businesses, any business concern, nonprofit, veteran organizations, or tribal businesses with less than 500 employees, or that headcount number may be based on location rather than for the entire company. The definition of wages, also very important to really understand to maximize both the loan proceed amount as well as that forgiveness component. And that includes wages, tips, commissions, as well as vacation, leave, excluding leave, as we mentioned, related to that Families First Corona Act. It includes retirement payments, insurance premiums, and state and local taxes. And again, there is a $100,000 limitation. People who earn more than $100,000 are not excluded, but the amount is limited to $100,000 per employee, and therefore you have to exclude any amount in excess of that. So the 8-week period, again, it begins immediately after you receive the proceeds. So very important to know and try and get a heads up as to if you are going to be approved for the loan, if you qualify, when is it that you can expect to receive those proceeds, so you can begin to immediately manage and measure headcount and dollars to maximize forgiveness. We already touched on this, but we'll go through it one more time quickly. Payroll costs, mortgage interest, interest on real and personal property, rent payments, had to be a lease that was enforced before that February 15th. We talked about important dates and timelines, utilities, and again, critical to really manage and measure during this 8-week period to maximize forgiveness. There is an exemption for rehires. Many businesses are concerned because they either had layoffs or they furloughed employees prior to this CARES Act coming out. So the headcount reduction is based on averages. Again, these are also in the important dates and timelines that we discussed, and understanding which is the best option for you to optimize that forgiveness. So those dates, again, are February through June of 2019, January and February of 2020, and then the covered period being February through June of 2020. And the wage reduction, that 25% that you cannot exceed, that is based on salary and wages. The terms of the loan, this is something that has changed, and it could change again. As Ryan mentioned when we started this webcast, this is changing on a daily basis, and there's still some guidance expected to come out. So when this first came out, it was a 10-year amortization period with interest capped at 4%, but today it is 2 years and 1%. And the application itself, it's a little bit oversimplified, but we are hearing that there will be post-loan verification, and you should be prepared to have supporting documents to submit to your bank to support the application and the amounts that you have put forward to calculate the loan proceed amount. I am going to hand it over to Ryan to discuss some of the other provisions within the CARES Act.
I think there's a lot of planning that's going to need to go into making sure you maximize your loan amount, as well as on the back end maximizing the loan provision. So that was very helpful in laying that out. The CARES Act also included two other areas that were tax focused in impacting and helping provide relief to affected businesses. The first is the employee retention credit. The employee retention credit is a credit allowed to offset employee requirements for payroll taxes. This program is offered separate from the PPP and exclusive from the PPP. So if you are taking advantage of the employee retention credit, you are not eligible for the loan forgiveness portion of the PPP program. With that said, the employee retention credit is applicable to all taxpayers, including those with employees over 500. So if you have more than 500 or the SBA standards exclude you from the PPP, the employee retention credit may be a valid option to help provide relief to your business during the COVID-19 crisis. The employee retention credit is a refundable credit against your payroll tax liability of 50% of qualified wages paid to employees, capped at up to $10,000 of wages. Essentially, your credit can be up to $5,000 per employee based on wages paid during specified periods. The wages taken into account for the employee retention credit cannot be counted as part of the Family First Coronavirus Response Act, similar to what Alisha went through for the PPP program. The procedural details behind claiming the employee retention credit are starting to come to light. Last Wednesday, the IRS released Form 7200 in draft form, which lays out how employers would claim this credit and provides them the option to claim the credit as often as they would like based on their pay periods during the covered periods in which they would be eligible for the credit. Again, I just want to emphasize you cannot take the employee retention credit and the loan forgiveness program that Alisha spoke of, the PPP. So I mentioned a specified period and qualified wages as part of the employee retention credit. There are two options for specified periods, and there are two applications of qualified wages. Specified periods, the first is for a fully or partially suspended business due to the appropriate governmental authority limiting commerce, travel, and or group meetings due to COVID-19. So as many of us are in a shelter in place order by their local, state, or local governments, this would be the triggering event of the start of this specified period, which would last through the lifting of the shelter in place, assuming you are fully or partially shut down as a result of this limitation. If you are deemed an essential service, we do not believe you would be qualified if you are operating at a normal capacity. Further guidance may clarify that if you are in an area of authoritative limiting, you may qualify, but that would be pending. The second way to calculate your specified period begins in the quarter in which your gross receipts are 50% of the gross receipts of the same quarter in prior year. So now we're at the start of Q2 in 2020. So if your Q1 2020 gross receipts were 50% less than your Q1 2019 gross receipts, that would start your specified period for this credit. And that period would carry on until the end of the quarter in which your gross receipts were greater than 80% of the gross receipts for that same quarter in the prior year. For example, if in Q3 of 2020, you achieved greater than 80% of Q3 2019's gross receipts, your specified period would end then, and you would have Q1, 2, and 3. Defining qualified wages are based on the employer size. For employers with 100 or less employees, all wages paid during the specified periods would be eligible for the tax credit. So if you're less than 100 employees, it's a relatively straightforward calculation once you identify your specified period. For employers with more than 100 employees, the qualified wages are only applied to employees who are furloughed or unable to work due to either a governmental shutdown or due to closing a location because of the drop in gross receipts. Wages paid to those employees for over 100 employers are the eligible wages, which are eligible for the 50% credit against payroll taxes. So it's a little bit complicated on the larger employers, but for those who are furloughed and are still receiving pay or benefits, that cost to the employer would be a qualified wage for purposes of the employee retention credit. In addition to, on the employer payroll tax side, the CARES Act allows for the deferral of the Medicare payroll or Social Security payroll taxes through the end of 2020. Again, this provision is exclusive from the PPP program that Alisha spoke of, and you would not be eligible for loan forgiveness if you are deferring payroll taxes under this provision. Again, with that said, it may be beneficial for larger employers. You are able to defer your payroll taxes for the remainder of 2020, and the payment would not be due until December 31st, 2021 for 50%, and the remaining 50% due December 31st, 2022. So you'd essentially receive almost over a year and a half deferral on 50% of that amount, which is a great cash flow option for our larger employers, as well as those that may not achieve the same benefit under the PPP program. Now, the last bucket that I wanted to quickly talk through as part of the CARES Act. So if we think of the CARES Act in 3 areas, the first would be the PPP program, and that's funding available to companies. The second is employer payroll tax. That's the credit or the deferral of payments on those. And the third bucket is the business income tax changes. The CARES Act temporarily repealed several of the tax limitations in place under the Tax Cuts and Jobs Act, which was the tax reform passed at the end of 2017 under the current administration. The CARES Act provides for a temporary repeal of the limit of the net operating losses. So net operating losses are now eligible to offset 100% of taxable income. Previously, under the Tax Cuts and Jobs Act, it was limited to 80%. Net operating losses are also now eligible for a 5-year carryback from the year of the tax loss to offset taxable income in prior years and generate the opportunity to claim a refund. For non-corporate taxpayers, so that would be your flow-through entities, partnerships, S-corps, the loss limitation under the Tax Cuts and Jobs Act, which capped the loss at $500,000, has been temporarily lifted as well. For C-corp taxpayers who have an alternative minimum tax credit carry forward as part of the Tax Cuts and Jobs Act. That credit carry forward can be accelerated and completely offset in 2019 as opposed to the previous curing period through 2022. The deductibility of interest expense has been increased to 50% of your adjusted taxable income based on or in an adjustment to the Tax Cuts and Jobs Act as well, which had previously set the limit at 30%. Finally, the provision for bonus depreciation and shorter tax life for qualified improvement property has been retroactively made through September 27th, 2017. This is often referred to as the retail glitch, which was a drafting error in the Tax Cuts and Jobs Act that excluded qualified improvement property from the 15-year short life for depreciation purposes and made it ineligible for bonus depreciation. So now this is retroactively applied to allow companies to accelerate deductions related to these costs. And one of the, just from an overall income tax standpoint review, many of these temporary changes were made retroactive into 2019, which provides a significant planning opportunity for those taxpayers who have not filed their 2019 tax return, with the due date being extended to July 15th. Taxpayers now have the opportunity or the ability to assess if they are benefited by any of these changes and take those on their 2019 tax return, hopefully accelerating a tax benefit into the current period, as opposed to claiming this tax, as opposed to only being able to claim this on your 2020 tax return, which most taxpayers would not see a benefit of until about a year from now, when the 2020 tax returns are due in April of 2021. So this provides a planning and relief opportunity for those businesses that have been significantly impacted and can accelerate or improve their cash tax planning. With that said, I think we're going to go to Jeremy and the
Yes.
question and A session.
Yes, thank you.
I heard a few pings coming in, so I'm guessing we have a couple out there.
Thank you. Yes, thank you, Ryan, and thank you, Alisha, for these very comprehensive presentations. So I would like to start with one question that was asked by the audience today. So for the size of business, the size limitation, is this at the global level or just USA?
Sure, that's a great question, and right now we believe it's at the USA level. There were changes made to the SBA application, as well as guidance released by the SBA last Thursday that seemed to focus the intent on US employees only. The SBA also indicated that further guidance on the issue will be released shortly. We haven't received that, well, as of the start of this webcast, but we're expecting that soon, and we hope that that will clarify and solidify our belief that it is just based on US employees.
Okay, another question we had was, do wages include bonuses?
Yes, wages do include bonuses as well as severance. It just cannot exceed that 100K limitation. So anything up to $100,000 would be included.
Okay, thank you. Another question we had was the Accountants Association said the payroll taxes are not included. Can you confirm that?
There's been a lot of confusion and a lot of noise around this specifically. I'm sure many of you have been receiving notifications daily from your payroll providers with them changing the reports as it pertains to this. Our understanding is that it is based on gross pay, and that you can include, in addition to the gross pay, your state and local taxes for purposes of calculating the loan proceed amount.
Okay, very good. Another question was regarding the restriction on foreign-owned companies. I know there's been a lot of back and forth on that recently. Can you clarify what is the definitive position from the Washington administration?
I don't know if we can give the definite definition, but our understanding, so the SBA they updated their form last Thursday, as I mentioned, and it began to focus on the U.S. employees. So they actually removed the foreign ownership question from the form. And as a part of that, they entered that the payroll included above is for U.S. physical residents only, not to comment on immigration status, but to focus on their physical location in the U.S. in applying to the program.
Okay, thank you. One audience member asked, can you repeat the affiliation rules?
So the affiliation rules are the same as they were under all other SBA loans. So they have not changed, other than if you fall under that certain industry code. So beginning with 72, so restaurants would fall under that, as well as franchises. So if you are a restaurant, for example, they would look at it by location instead of your overall company headcount. Otherwise, the affiliation rules are the same as they always were.
Okay, very good, thank you. Another question was, can a 501c6 membership-driven business association that has a non-for-profit corporation designation and does not lobby, has only one employee, can such a company, an organization, apply for the PPP? And also another question together with that is it possible to apply both for the economic injury disaster loan and the PPP? And last question, if we are eligible for both the economic injury disaster loan and the PPP, and apply for both. Sorry, I can't read the last part of the question. Yeah, so could you answer the first two questions regarding 501c6 and regarding applying jointly for economic injury disaster loan and PPP?
So I'll jump in on the first one there. The definition of nonprofit in the Act is 50C3 and 19, and that would be a veterans organization and a 503C nonprofit, the 501C3 nonprofit. I believe that excludes the 501c6 as it's currently written.
Okay. And the second question was that, is it possible to apply both for the economic injury disaster loan and the PPP? And if we are eligible for both and apply for both, are we permitted to accept both if granted, or only one?
So I can answer that. You can apply for both. Many people, in fact, had already applied for the EIDL loan prior to the PPP, the Paycheck Protection Program, coming out. The one provision is that you cannot use the funds for the same purpose. So if you receive funds under the EIDL, you cannot use those funds to cover something that is going to be covered under the PPP and ultimately forgiven. So it has to be for something other than what you are going to use the PPP funds for. But you can apply for both. When you apply for the EIDL loan, you do not apply for a certain amount. So you do not know whether or not you are going to be approved. And if you are approved, it is uncertain until you receive further notification as to the amount that you would be approved for. But should you be approved and they tell you the amount that you're going to be approved for, you do not need to draw on it. You can determine that or decide that you received funds under the PPP, and if you no longer want to take the funds under the EIDL, you are not obligated to.
Okay, very good, thank you. One question is, can employees with a visa be included in these applications?
Again, our understanding today is that the physical location of the employee is what is counted. So they would need to be in the U.S. being paid through the U.S. company. Their immigration status is not indicated anywhere in the act or in the guidance afterwards. So I would say if they are in the U.S. and receiving U.S. payroll, they would be eligible.
Okay. One question is the employee retention credit. Does it only apply? Does it apply if, or does it only apply if one employee filed for family or medical leave?
So the employee retention credit applies to wages paid during an impacted period of the company, that specified period. It does not relate to any sick or family medical leave. There is another credit under the Family First Corona Response Act that would apply to family and sick leave. So there's two separate credits there. The employee retention is just for wages paid during the specified period of impact. The Family First is related to sick and family leave time.
Okay, thank you.
And you can't claim one for the same wages as the other, and you can't claim the Family First wages on the PPP program.
Okay, thank you. Another question is for the affiliation rules. If our company is owned by a larger group where we have more than 500 employees, are we not eligible for the PPP?
If the 500 employees are in the US, you can look through your SBA size standard code for the affiliated group. But I would assume based on that question, you're going to be larger than that as well. So if they're US based, you would be excluded from the PPP program. If they're outside of the US, we anticipate them only looking at US employees, again, pending the future guidance. That's our thought right now.
Okay. I have a question here, but I believe you already answered it. Maybe can we be eligible for the economic injury disaster loan if we have 80% ownership by non-US citizens?
Yes, so it is our understanding. Again, they did change the application to remove foreign ownership provisions. So I'm not entirely certain on the EIDL. I know that they removed it on the PPP, but again, I think it's based on U.S. employees rather than ownership.
Okay, very good. I think we're coming to the end of our webinar. So again, I want to thank Alisha, Jernack, and Ryan Vaughan for their very detailed and insightful presentation. And as I mentioned, we are going to be posting the slides of the presentation on our network. So look at the LinkedIn page of the French American Chamber of Commerce New York chapter. We will put a link to the slides also on our newsletter, and also we will make available to the participants of today the recording of this webinar. So again, thank you, and I want to invite you to attend the other 2 webinars of our stimulus series. We have one tomorrow at April 8th at 2 p.m. with the law firm Shepherd Mullin. So we'll look at all the main provisions of the CARE Act and especially look at foreign ownership provision, but also should you or should you not apply for each of these provisions. So you will have the point of view of a law firm, and we'll have more point of view also on the tax sections on April 13 with our member KPMG. Again, a look at the tax section of the CARES Act. So, so again, thank you, Alisha. Thank you, Ryan. And to all our members and guests, we look forward to be of service to you and see you soon again online. Thank you.
Thanks, Jeremy. Everyone
Thank
be
you.
safe.
Thank you. Be safe. Bye-bye.
Bye.